Apple is obviously one of the biggest companies in the world, one of the biggest success stories over the last 25 years. And I've owned shares for more than 15 years now. But there's more concern than I have for Apple as an investment today than I have for a very long time. And there are a number of reasons for that. One of them is that the stock is very expensive. Growth has slowed, but I think Apple is also showing itself to be moving to a less innovative and more mature phase of the market. It's trying to extract more from customers rather than building products that customers value. So that's what I'm going to dig into today is what some of the numbers look like, where we're at with a valuation standpoint, and why this is a stock that over time I've slowly been selling off because I think the long-term future is just not as attractive as it is in other parts of the market. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they're going to give you their top 10 stocks to buy right now. I want to start this discussion with a couple of charts because I think this shows where Apple is today in its development cycle. This first chart shows Apple's revenue in black and net income in orange. And these are annual numbers. And on the bottom there, you can see the compound annual growth rate over that period of time. So since 2014 through the end of fiscal 2023, the company grew at a compound annual growth rate of 8.6%. That's fine, but that is not a high growth stock that you would want to pay a huge premium for. I'm also going to get into where that growth came from in just a second, but that's another thing that we want to keep in mind. Net income up 10.5%. Again, really good numbers, but not necessarily a kind of stock you want to pay too much for, especially if we look at the last 3 years. Since the end of 2021, the December 2021 quarter, Apple's revenue has grown at a compound annual growth rate of just 0.7%. And depending on which quarter you're comparing against, revenue is actually down over that period of time. Same thing goes for net income. Compound annual growth rate is a negative 2%. And all of these numbers are on a trailing 12-month basis. So they should be pretty comparable to each other. It takes out some of that variability that happens around the holiday quarter. But I think this is really the context we need for investors. What do you pay for a company that's not growing on the top line and is actually shrinking on the bottom line? Now, there are a number of reasons for this, but the fundamental problem for Apple is that iPhone sales, which has driven the company for more than 15 years, are simply not growing the way that they used to. People are using iPhones for longer. They're not able to increase prices as much as they have been in the past. They're moving into more discount markets. So that iPhone revenue just isn't growing. So you got to grow your revenue somewhere else. That gets us to where I want to focus, because this is what's ultimately really concerning, is where Apple is actually growing and where it's not, because I think this growth may not be as sustainable as a lot of investors would like to think. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. This is a chart that shows Apple's major product segments, 3 major products, the iPhone, Mac, and iPad. You can see that iPhone revenue was growing nicely through 2015. And since then, things have really slowed down. So if we just look at this whole 10-year period, you get a 9% compound annual growth rate for the iPhone. The Mac and iPad, on the other hand, are essentially flat. Mac revenue is up 2% on a compound annual growth basis, and iPad revenue is down slightly at 0.8%. Again, depending on where you use your comparison, the growth rates may change just a little bit. But I think the general story here is that iPhone sales are rising slightly as they're increasing prices, but we definitely don't have this as a double-digit growth rate product anymore. And the other products, the Mac and the iPad, are absolutely not growing. So where is Apple actually getting growth from? And that's pretty clear. Apple's growth is coming from accessories and services. Accessories, which is shown in this black column, the growth is actually driven by AirPods. This includes all kinds of other accessories that they're selling in stores. It also includes the Apple Watch, but AirPods is really where you start to see the growth pick up in that 2016, 2017 range. And that has become the major growth product. But you can see we're pulling back a little bit over the past year. Services, on the other hand, doing extremely well. Services revenue has a 19% compound annual growth rate over the past decade and continues to grow. But this is fundamentally the problem for Apple. Apple's best source of growth is services, is products that they're, in most cases, just taking a skim on someone else doing something with their devices. So this is revenue that's coming from the App Store. It's revenue coming from Google for their searches. It's revenue that's coming from payments. So why is Apple trying to protect the App Store so much with some of these lawsuits, both in the US and in the European Union? It wants to make that 30% on every transaction that happens in the App Store. And why is it so focused on generating that 30% revenue? Because that's where all of its growth is coming from. This is fundamentally the problem with Apple. The only way that they can grow is continue to take a larger and larger piece of the ecosystem because the ecosystem itself is not growing. That is not fundamentally a place you want to be for a stock that is not cheap today. Let's go to some of those valuation metrics. As I'm recording, this is after the close on Monday, January 29th. Price to earnings multiple on a trailing 12-month basis is 31.4. On a next 12-month basis, 29.2. So there's where you're seeing not a lot of growth in earnings expected from investors. So we have at best a single-digit percentage growth company that you're paying 30 times earnings for. That's really expensive. Price to enterprise value to sales, 7.7 on a trailing 12-month basis, 7.4 on a forward basis. Again, not a high growth company. And that's why that enterprise value to sales multiple is not coming down. Price to free cash flow, 29.9 on a trailing basis and 27.3 on a forward-looking basis. Those are the kinds of multiples that you pay for companies that are growing double digits. And Apple is not that company anymore. What investors need to keep in mind is that what you pay for a stock matters. And in Apple's case, the last decade, there's been a ton of gained from simply multiple expansion. You can see this in this chart here. 10 years ago, the stock was trading for 15 times earnings. Now, that was when the company was growing even faster. The services business is not what it is today. The iPhone was still growing. AirPods were still not being made. So you had a lot of growth ahead of you. Where is the growth coming from for Apple in the future? I think I could make a better argument that the company's revenue is probably going to decline as people use their iPhones longer, as more developers try to find ways out of paying Apple money in the App Store, and as the competition simply gets better. I think the difference between an iPhone today and any number of other smartphones is simply smaller than it has been at any time over the last 15 years. That gap is not what it used to be. The ecosystem is not significantly better. So these are all major challenges for Apple. And I think one of the disturbing things that I see as an investor is that the company is not coming out with new and innovative products in order to grow its business. It's trying to just take more money from its developers and suppliers in the market. These lawsuits that are related to the App Store, to that 30% fee, the fact that they want to go back and say, hey, you know what, you can use whatever payment structure you want, but we want a 27% fee for providing you the technology to build your apps. That is just a terrible way to run a business and make money on your business. It makes developers angry. This is why some of the biggest apps in the world are not going to be available on the Vision Pro at launch. And I think we see more and more subscription companies just say you're not going to be able to get your subscription on Apple. You're going to have to go somewhere else, go directly to the website. And then Apple's devices just become reader apps and that makes it easier for customers to move to other devices. If you have a Spotify subscription and a Netflix subscription, it doesn't really matter what ecosystem you're in. If you're on a Samsung phone and you have a Mac, it just doesn't matter. The device doesn't matter. There's no lock-in in the ecosystem the way there has been for most of the last 10 or 15 years. So I think there's a lot of warning signs here for Apple just from a valuation standpoint. This company isn't going anywhere. That is not in any way what I'm saying in this video. But as an investor, we have to look at what we're getting for the price that we're paying. And I think that is less attractive today than it has been at any time over the last 25 years for Apple. But what do you think? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.